Hi, welcome to part 3 of our 3-part video series on structured products. In part 1, we discussed what is a structured product, talked about how they work, the different terminologies that are used in them, and some of the advantages that we have in creating them for you. In the second video, we talked about growth notes, which is a replacement for equities or the stock portion of your investment portfolio. And in this video, we're going to talk about callable yield notes or income notes, which would be a replacement for part or all of your traditional fixed income. Traditional fixed income is tied to interest rates, whereas callable yield notes are tied to a benchmark, anything that you can do an option on. Again, as with our growth notes, we prefer to do broad-based indexes that we feel are less volatile and tend to move less than individual securities do. These were extremely useful during 2022 when traditional bonds performed at a negative 14% on the aggregate bond index because as interest rates rose, bond prices fell. And our callable yield notes were tied to equities, not to interest rates, so they performed in a much more consistent manner. When creating callable yield notes, we use what's called a barrier. If you watch the second part of our video series on growth notes, we discussed those notes used a buffer, which was a hard protection. With our income notes, we use a barrier, which is slightly riskier, so we're going to use a little bit bigger downside protection. We typically create 2 different notes, and we put our clients in whichever one fits their risk tolerances, but we do one that's got a 70% barrier, which means it has 30% downside protection, and we do a more conservative 55% barrier, which has a 45% downside protection. We then determine how often do we want to receive income. Most of the cases for us, we are doing quarterly, so every 90 days from the date of purchase, and those are called observation periods. We're going to take a look at how this note operates. So we created the note, let's say today. 90 days from now is going to be an observation period. We're going to take a look at those indexes that we did, and in this example, we're going to do the S&P, the Dow, and the Russell, and we're going to do what's called the worst of. So at that 90-day observation period, as long as none of the 3, or the worst, is down more than the barrier, as long as none of them are down more than 30%, you will get paid your income. If one of those indexes is down more than 30%, you would miss that income, and then you would move on to the next period. The third thing that could happen is the market could be higher than where we bought the notes. So you bought the notes and the stock market rose and all 3 indexes are higher than the day we bought it. In that case, the bank has the right to call the note. There are some notes that are automatically called and there are some that are issuer called. We tend to stick to the issuer callable notes, which means they would have to actually make a decision to call the note from us, in which you would still get that quarter's payment, and then you would get all your money back, and we would reinvest it in a new note. So you're not really out anything besides the opportunity cost if the new note is not paying the same amount of income as the old note. So what kind of income do these pay? And that's going to be determined upon where the volatility index is and where interest rates are. And that's going to change every single day. So it does move around quite a bit, but right now, I'd say the safe number would be between 10.5% to 12% is what we're typically seeing. On the deeper barrier notes, the 45% downside protected, you're not going to get as high of an interest rate because you're getting more protection. Somewhere between 2 to 3 percentage points, as high as 4 percentage points lower than the 30% downside protected notes. Your principal would only be at risk at maturity. For example, if the market is down between 0 and 30% at maturity, you would get 100% of your original investment back, plus your income payment. But if it's down more than that, then you would have a risk of losing part of your principal. So if it's down 31% with a barrier, you would actually lose 31% of the original principal and miss your coupon payment for that quarter. That sounds very risky, but let's take a look at and diagram what that would actually look like. If we did a $1 million investment for 3 years at 12%, and we diversified that into 5 notes at $200,000 each, with each of those notes having a different bank, having a different maturity, having different observation dates, trying to reduce the risk as much as possible, those notes would pay approximately $120,000 per year of income if they made all their income payments. So over a 3-year period of time, you could potentially receive as much as $360,000 of income. If at maturity we saw a catastrophic event that would cause the market to go down, and let's just use a really big number, let's just say 50%. It doesn't happen very often, but let's say it does. And let's say you lost one of your notes, you lost 50%, that would be a $100,000 loss. So if we took $100,000 out of the $360,000 that we would have earned in income, you're going to have approximately $260,000 total return for the 3 years. And it'd be slightly lower than that because you'd probably not get the income payment on that last payment date. But just to keep it an approximate level, around $260,000. Over 3 years, that's around an 8.5% to 8.75% return per year. One of the other major advantages that we have within Paragon is to work with you on your total portfolio to be able to create a ladder that might be all income notes, it might be all growth notes, or it could be a combination of growth and income notes. So you could replace a 60-40 portfolio with 60% growth notes and 40% income notes. And you can diversify an equity portfolio that has exposure to the S&P, small caps, and international by using the S&P, Russell 2000, and Euro Stoxx 50 as your indexes within the benchmarks. These are very customizable, and we're able to help you create a portfolio that'll help you reach your goals. We went over a lot of information in this video. If you have any questions, we would love to hear from you. We'd love to schedule a follow-up, either video chat or phone call, and discuss any of your questions or concerns. Please reach out to anybody at Paragon Capital Management, and thank you for watching our video series.